What if I told you that $100,000 invested in SCHD could generate a steady income stream without requiring you to work? But here's the kicker. How much can you really expect to earn per day, week, or month? The answer may surprise you, and it might just change the way you think about long-term wealth building. Stick around as we break it all down in real numbers and reveal why SCHD is considered the king of dividend investing. What makes SCHD different from other dividend ETFs? It's not just the name or the companies it holds, it's the process behind picking those companies. SCHD isn't about throwing in hundreds of stocks to spread risk. It's about focusing on the highest quality of dividend payers using a strict set of criteria to filter out the weak links. One of the biggest problems with many dividend ETFs is inconsistency. They might include companies with dividends that look attractive at first glance, but are unreliable or even unsustainable. Some ETFs try to fix this by holding as many stocks as possible, but this approach often leads to mediocrity. SCHD takes a different path. It focuses on strength. It's like running a sports team where only the top players even get a tryout. Every stock in SCHD's portfolio goes through 4 rigorous trials, and those trials make all the difference. The first trial is what you could call the endurance test. To even be considered for SCHD, a company must have paid dividends for at least 10 consecutive years. That's a full decade of proving they can reward shareholders consistently, no matter what happens in the broader economy. This eliminates companies that might look promising when the market is booming, but fold under pressure during a downturn. Think about it. In 10 years, a company is likely to face at least one tough economic period, maybe even a recession. By requiring this kind of track record, SCHD filters out those that can't handle the ups and downs. Next comes the growth challenge. It's not enough for a company to simply have paid dividends. It also needs to show positive earnings growth over the past 5 years. This step is crucial. It ensures that the companies in SCHD's portfolio aren't just treading water, they're improving. A rising earnings stream sets the foundation for future dividend increases, meaning you're not just getting stable income, but the potential for more income over time. A company stuck in neutral might keep paying dividends for a while, but it's the growers, the ones innovating and expanding, that are in it for the long haul. Then there's the financial fitness exam. This is where SCHD evaluates companies' return on equity and debt levels. Essentially, it's a deep dive into how well a business is using investors' money and whether it can manage its obligations without stretching itself too thin. Why does this matter for dividends? Because a company bogged down by debt or with poor financial returns is far more likely to cut payouts when times get tough. To avoid any weak links, SCHD prioritizes companies with strong balance sheets and efficient operations. Finally, there's the sustainability assessment, which focuses on the dividend yield itself. SCHD isn't interested in stocks that offer sky-high dividend yields if they aren't sustainable. Often, these extremely high yields are a sign that the market doesn't trust the company to maintain its payouts. Instead, SCHD picks companies where the yield is both reasonable and backed by a solid long-term business model. This step not only protects your income, but ensures it has room to grow. So what does this all mean for you as an investor? SCHD doesn't dilute its portfolio by holding hundreds of stocks like many other ETFs, such as Vanguard's VYM. For context, VYM includes over 400 companies. While that creates broad diversification, it doesn't guarantee the same precision as SCHD's hand-picked approach. With just about 100 holdings, SCHD zeroes in on companies that regularly excel in all 4 of these areas. It's a focused strategy designed to align quality with performance. To help put this selection process into perspective, think of it like elite military training. Not everyone who signs up makes it through the grueling courses, but those who do are the strongest, the most resilient, and the most reliable. SCHD's portfolio operates in much the same way. Every company has been tested, challenged, and proven to excel under pressure. This is why you'll find household names like Coca-Cola, Johnson & Johnson, and Procter & Gamble in its holdings. These aren't just companies with decades of consistent dividends, they've also shown the ability to grow their payouts year after year, even through market challenges. Compared to competitors like JEPI, which focuses heavily on higher immediate income, SCHD takes the long view. JEPI's payouts might be higher in the short term, but they lack the same emphasis on growth and sustainability. If JEPI feels more like a sprint, SCHD is a marathon, a tool for generating steady wealth over decades, not months. What really sets SCHD apart is how this disciplined investment approach translates directly into income you can depend on. When other ETFs falter during market instability, SCHD's uncompromising strategy helps maintain a steady stream of payouts. It sacrifices quantity for quality, aiming to grow your wealth reliably over time. But here's where things get interesting. How does this strategy translate into actual dollars? If you invested $100,000 in SCHD today, how much income could you realistically expect? And how does that income fit into daily life? That's what we're about to uncover. $100,000 might seem like just another number in your portfolio, but when it's invested in SCHD, it transforms into something more. It starts working for you every single day. The question is, how much can it realistically generate? Let's break it down. With SCHD's average annual yield sitting between 3.4 and 4%, $100,000 translates into yearly dividend income of roughly $3,400 to $4,000. For simplicity, let's use the midpoint, close to $3,400 a year. That breaks down to around $283 a month, $65 a week, or about $9 a day. Now, $9 a day might not sound like a lot at first glance. It's roughly the cost of a quick lunch or a streaming service subscription. But consider this. Unlike earned income, this money arrives passively, whether you're sleeping, working, or vacationing. It's cash flow generated by your investments rather than your time. One of the most common misconceptions about dividend investing is expecting huge, immediate returns. A lot of people imagine their dividends will immediately cover big expenses like mortgages or luxury vacations, and when they see $9 a day, they're disappointed. But there's a shift in mindset you need to make. SCHD isn't about chasing the highest numbers right out of the gate. It's focused on long-term stability and steady growth, not fluctuating high-risk payouts that could disappear overnight. The idea here isn't to get rich quick. It's to build wealth that lasts. To put it in context, think about your regular monthly expenses. The $283 per month generated by SCHD could easily cover a family's internet and phone bills, or even a week of groceries. Over a year, $3,400 could handle a few months' worth of utility payments or fund a weekend getaway. While these dividends won't overhaul your financial situation overnight, they provide a reliable layer of income that chips away at everyday costs. That's the beauty of it. Small, steady contributions that add up over time. Now let's talk about growth. One of the best ways to make a $100,000 investment in SCHD even more effective is by reinvesting those dividends. Instead of cashing out that $3,400 each year, reinvesting it buys more shares of SCHD, which in turn increases next year's dividend payouts. This is the power of compounding at work. Imagine planting a tree that not only produces fruit, but also uses that fruit to grow taller and produce even more fruit over time. Over 10 or 20 years, what started as a small pile of annual income could snowball into something much larger. Dividend payments big enough to cover significant portions of your living costs. For example, if you reinvest the $3,400 annually and SCHD's value grows modestly at 5% per year, your portfolio could grow dramatically over time. After 10 years, not only would your initial $100,000 have grown in value, but the annual dividends would also be higher, possibly surpassing $5,000 or more per year. And the best part? This growth happens without you adding another dime of your own money. The portfolio grows itself, giving you higher future payouts simply because you left it to do its work. This strategy is particularly appealing when you think about stability. Unlike riskier options like high-yield investments promising double-digit returns, SCHD focuses on companies that have a proven history of maintaining and growing dividends. These are businesses with solid financials. They aren't scrambling to pay dividends by taking on debt, and they aren't slashing payouts the moment market conditions get tough. That reliability is what gives SCHD its edge, particularly for investors looking to preserve and gradually grow their wealth in a sustainable way. Still, you might ask, why not chase higher yields elsewhere? While it's true that some ETFs or individual stocks offer double the yield SCHD provides, they often come with higher risks. There's no guarantee those payouts will last, and in some cases, they may even shrink over time. SCHD, on the other hand, builds its strategy on selectiveness. Every company it includes has passed its rigorous selection process, ensuring consistency and long-term viability. By focusing on companies with solid track records and room to grow, it creates a portfolio designed to weather the ups and downs of the market. When you consider the long game, this approach holds incredible value. Even if the initial daily income, $9, seems small, its reliability and the potential for growth make it a key building block for financial freedom. Over years of reinvesting dividends, what starts out as $283 a month could turn into a stream of income capable of paying significant portions of your living expenses. So, $100,000 in SCHD isn't just money sitting in an account. It's a step toward building a lifestyle where your investments cover more of your costs. Reliable, growing income like this represents financial momentum. Now imagine how you could enhance that momentum by diversifying with other ETFs. Let's explore how combining SCHD with a broader portfolio could take it even further. What if you could take the steady income from SCHD and amplify it significantly by combining it with other high-yield ETFs? That's the potential power of diversification. Instead of relying solely on one investment to deliver all your income, spreading your money across multiple ETFs can create a more balanced and often more rewarding portfolio. It's like giving your income strategy multiple streams to flow from, rather than depending on just one. Let's start with the basics. Diversification in dividend investing means allocating your money across different ETFs with unique strategies. Why? Because every ETF has strengths and weaknesses, and no single fund is perfect on its own. By combining ETFs, you not only spread your risk, but also open the door to higher income potential. Think of it this way. Depending on one investment for your dividends is a little like putting all your calories into one meal. It might get the job done temporarily, but it doesn't create lasting balance and health. The same principle applies here. One popular approach for diversification is something called the Dividend Trinity strategy. It focuses on using 3 ETFs, SCHD, JEPI, and QYLD. Here's how it works. You allocate 40% of your portfolio into SCHD, 30% into JEPI, JP Morgan's Equity Premium Income ETF, and another 30% into QYLD, which focuses on NASDAQ 100 stocks. Each of these ETFs serves a specific role in the portfolio. SCHD is your foundation, providing consistency and long-term growth. JEPI delivers higher monthly income, while QYLD is the high-yield option that adds an extra boost for those seeking substantial payouts. So what does this look like in numbers? Let's take the same $100,000 investment we talked about earlier. With the Dividend Trinity strategy, you'd put $40,000 into SCHD, $30,000 into JEPI, and $30,000 into QYLD. SCHD, as we've seen, offers a yield averaging between 3.4 and 4%, So $40,000 in SCHD would generate roughly $1,360 to $1,600 annually, or around $113 to $133 per month. JEPI, with its higher yields of approximately 8 to 9%, would provide $2,400 to $2,700 a year from the $30,000 allocation. That's about $200 to $225 per month. Then we have QYLD, which averages an even higher yield, often around 10 to 12%. On $30,000, QYLD could bring in $3,000 to $3,600 annually, or a monthly income of around $250 to $300. When you add it all together, this diversified portfolio could potentially generate $588 per month, or about $7,000 per year. That's more than double the $283 monthly income from investing solely in SCHD. Those extra cash flows can have a huge impact whether you're looking to reinvest, cover more expenses, or build a safety net for unexpected costs. Diversification in this case doesn't just improve stability, it significantly boosts your passive income potential. But this isn't without trade-offs. Each ETF comes with its own quirks. JEPI's strength lies in its ability to produce high, reliable income, but it achieves this by using a covered call strategy, which caps some of the potential for growth. In other words, it's a great ETF for income now, but you might sacrifice some of the upside if the market experiences a strong rally. QYLD, on the other hand, is even more aggressive in its high-yield approach, using a similar covered call strategy on NASDAQ 100 stocks. This offers impressive monthly payouts, but it comes with higher risk due to the volatile nature of tech-heavy markets. While QYLD delivers substantial income, it may not provide the same long-term growth or stability as SCHD. That's why SCHD remains the foundation in this strategy. It offers the balance of growth and consistency the other two funds might lack. If you're wondering how to visualize this, think of it like a balanced diet. SCHD serves as your base, lean proteins and whole grains, the building blocks of strength. JEPI, that's your consistent energy source, maybe like healthy fats that keep you fueled over the day. And QYLD, it's the spice, a bold, flavorful addition that makes the dish interesting, but isn't something you'd rely on exclusively. Just like a diet needs variety to stay healthy, your portfolio benefits from diverse income sources, ensuring one ETF struggle don't sink the entire ship. The beauty of the Dividend Trinity strategy is that it offers options. You get both short-term higher yields and the potential for long-term growth. It's a combination that can help weather market volatility, economic downturns, or flat periods in any single ETF's performance. For example, if QYLD underperforms in a tech downturn, the steadier performance of SCHD or JEPI can help offset those losses. Similarly, SCHD's disciplined strategy of focusing on financially strong companies keeps the portfolio grounded, even when higher yield options like JEPI and QYLD take on more risk. This isn't just diversification for the sake of it. It's diversification with a targeted purpose, maximizing income while minimizing risk. By spreading your investments across different strategies, you create a safety net that reduces reliance on any one fund and lets your portfolio thrive in various market conditions. But here's the next challenge. How do you prepare a strategy like this to withstand the long-term pressures of the market? Let's explore what it takes to keep your dividend investments strong over the years. What if one day your investments could pay for everything? Bills, groceries, vacations, without the need for a paycheck. That's the power of dividend investing. It may take time, but the results can be transformative. Over the long haul, dividends are so much more than periodic cash payments. They're tools for building genuine financial independence. At its core, a dividend strategy revolves around patience and consistency. This isn't about turning a quick profit or chasing the next hot stock. Instead, it's a methodical process that rewards discipline. Dividends provide a steady stream of income, But the real magic happens when you reinvest those payouts instead of spending them. This reinvestment creates a compounding effect, one of the most powerful forces in building wealth. Essentially, you're not just earning returns on your original investment anymore. You're earning returns on your returns. Over time, this snowball effect can grow your portfolio exponentially without requiring you to add as much new money. Let's look at an example. Imagine you start with $10,000 invested in a dividend-focused ETF like SCHD and then contribute $1,000 every month. Assuming an average annual return of 8%, which accounts for both dividend payouts and modest market growth, that portfolio could grow significantly. After 10 years, it wouldn't be just the $130,000 you contributed. Thanks to reinvested dividends and compounding, it could grow to about $184,500. At that point, your annual dividend income might be approximately $7,380 or $615 every month. That's not just theoretical income. It's money that could start paying for real expenses. Now take that same strategy and stretch it to 20 years. After 2 decades of disciplined investing and reinvesting dividends, that portfolio could balloon to over $548,000. And here's the exciting part. By that point, it could generate roughly $21,920 in annual dividend income. That's $1,826 every month, enough to cover housing, utilities, or even fund early retirement plans. This is how dividend investing quietly transforms into something life-changing. What started as supplemental income turns into something much larger, all because of consistent contributions and the power of reinvestment. SCHD plays a unique role in this journey because of its focus on stability and growth. Its portfolio isn't just a random collection of dividend-paying companies. Every stock meets rigorous standards, from having a decade's worth of dividend payouts to demonstrating strong earnings growth and financial health. Companies like these provide a solid foundation, ensuring the dividends you receive are both reliable and sustainable. That reliability makes SCHD an ideal choice for creating the backbone of a wealth-building strategy. It's not a flashy, high-yield option, but that's exactly why it works. Slow and steady growth is what keeps the engine running over the years. To understand what this approach can lead to, imagine a future where you no longer rely on a paycheck. Picture waking up in early retirement, knowing your portfolio generates enough passive income to cover your living costs. Maybe it funds travel plans you've always dreamed of, or it lets you spend more time with family instead of worrying about work deadlines. Aren't dictated by how many hours you can trade for money. That kind of life is built through years of deliberate investing decisions. The early years of this strategy are crucial, and they require a shift in mindset. In the beginning, your dividend income might feel small, barely enough to cover a subscription or a dinner out. It's tempting to think those amounts don't matter, but the key is reinvestment. Every dollar you reinvest buys you more shares, which increases future dividends, creating a cycle that builds momentum over time. Skipping this step is like trying to roll a snowball uphill. It stalls before becoming anything substantial. But by reinvesting consistently, you accelerate growth, turning modest beginnings into something significant. Now, some people might wonder why dividends are worth pursuing when there are other, more aggressive investment strategies out there. What makes dividends unique is their combination of reliability and scalability. Even during market downturns, high-quality companies like the ones SCHD holds often continue to pay and even grow their dividends. This resiliency creates a sense of stability for investors. It's not about chasing huge swings in stock prices. It's about laying bricks for a solid financial foundation. Over time, that foundation becomes a structure you can rely on, a portfolio that starts to look like a second income. The patience dividend investing requires might feel like a hurdle, especially since it's not an instant payoff. But think of it as planting a tree. You water it, nurture it, and watch it grow. For the first few years, you might not see much beyond some thickening branches, but fast forward 10, 15 or 20 years, and that small tree turns into something that not only provides shade, but bears fruit year after year. Dividend investing works the same way. The early stages are about reinvestment and patience, but eventually the results start to compound and you'll see the rewards of years of diligence. So if it's not just the numbers that make dividend investing attractive, it's the lifestyle it can create. When that income eventually replaces the need for a regular paycheck, it's transformative. Now that you see the potential, how do you take that first step? Let's break it down. Dividend investing isn't just about the numbers. It's about creating a foundation for freedom and choice. By reinvesting dividends and staying consistent, you're not just growing your portfolio, you're building a future that lets you live on your terms. Even starting small can lead to significant results over time. Imagine your investments growing steadily, paying for expenses, and giving you the freedom to focus on what truly matters. The key is to take that first step. Whether it's investing in SCHD or exploring other options, the journey begins with action, and every decision you make is a step closer.